Okay, let's go ahead and talk about the second aspect of partnership changes, and that is the case where a partner retires. And again, let's go ahead and go back to our Alan, Bob, and Chuck partnership. We have the same data we had when we talked about new partners coming in. Now, when a partner retires, basically he's going to, in a sense, cash out his equity account, his equity claim. And of course, the retiring partner wants to receive as much as possible. At the same time, the remaining partners want the retiring partner to get as little as possible. So we have sort of a tug of war over the amount of cash to pay out. And of course, the parties should, they should negotiate. Again, the retiring partner wants as much as possible. The remaining partners want to pay as little as possible. Both parties have some leverage here. Basically, if they can't come to a mutually satisfactory agreement, then any one of the partners can say, look, I insist that we liquidate the partnership, convert all the assets to cash, close down the business, and pay out the capital balances to the partners. Now, if they were to close out the business, as a going concern, the business has more value than the value of the individual assets. And so liquidating the partnership would really be a last resort if it's a viable going concern. And let's go ahead and start with the assumption that Bob, the middle partner, is going to retire and is going to be paid $250,000 of partnership assets, cash, for his ownership stake. In this case, Bob is being paid exactly his capital balance, and so it's a very simple matter to go ahead and write a check on the partnership's checking account and give that to Bob, and that pays out Bob's capital balance of $250,000. Firm assets have been distributed to the owners, so that reduces the equity, and basically Bob's equity account is zeroed out. Let's now go to case B, where Bob retires, and instead of being paid his capital balance of $250,000, instead he's paid $350,000 of partnership cash. And again, why would this happen? Well, if the partnership is worth more than book value, then Bob's share is worth more than book value as well. And as before, we have two choices on how we're going to go about accounting for this. The simpler of the two is the bonus method, where basically that extra $100,000 that Bob gets is going to be taken out of Alan and Chuck's capital accounts. Or we have the goodwill/asset revaluation method. Let's go into the bonus method first. Again, Bob is getting an extra $100,000, and that's going to come out of Alan and Chuck's capital accounts in their profit-sharing ratio. So Bob's capital account of $250,000 is zeroed out. The partnership writes a check for $350,000, and that extra $100,000 comes out of Alan's and Chuck's capital accounts in their profit-sharing ratios. So Alan bears 3/8 of that bonus, while Chuck bears 5/8 of that bonus. Again, case B, Bob is going to retire, being paid $350,000 of partnership cash. The second method is the goodwill method. And under the goodwill method, we acknowledge that Bob is getting more than book value because the partnership is worth more than book value. That increased value is again either due to misvalued assets or liabilities, or it's due to goodwill. Now, we have two variants of the goodwill method here. First and simplest is what's called the goodwill to retiring partner only. And basically, we're going to treat goodwill as a plug figure. Basically, that extra $100,000 we're giving Bob is simply going to attribute that to goodwill. So again, we write a check for $350,000. We close out Bob's capital balance, and that $100,000 difference, we simply say, hey, the partnership's worth more than book value. We need to create some goodwill to recognize that. The second variant is where we could give goodwill to all the partners. Now, in this variant, we acknowledge all of the additional goodwill. We need to create enough additional goodwill so that Bob's share is $100,000. Now, since Bob gets 20% of any profits and losses, that means that the total goodwill that we have to create is $500,000, of which Bob will get 20% or $100,000. So we go ahead and create $500,000 of goodwill. We're going to split that between Alan, Bob, and Chuck in their profit sharing ratios. So Alan gets 30% or $150,000, Bob gets 20% or $100,000, Chuck gets 50% or $250,000. This brings Bob's capital balance up to $350,000, and now we can go ahead and give him his check for $350,000. In this example again, I'm debiting goodwill simply as a convenience. We could again revalue any misvalued assets. So if we have undervalued land or undervalued equipment or undervalued buildings, we could go ahead and write those assets up in value. Again, it's simpler just to call it goodwill and be done with it. Finally, let's go ahead and look at case C, where Bob retires and is going to be paid only $200,000 of partnership cash. Again, Bob's capital balance is $250,000. He's only being paid $200,000, and we have the same two choices as always: the bonus method and the goodwill or asset revaluation method. As always, the bonus method is simple. Basically, Bob is getting $50,000 less than his capital balance. That extra $50,000 will be split among the remaining partners. So again, we zero out Bob's capital account, we give him his $200,000 check, and that $50,000 that he's, in a sense, leaving behind is going to be split between Alan and Chuck in their profit sharing ratio. 3/8 to Alan, 5/8 to Chuck. Under the goodwill or asset revaluation method, we will again argue that the reason Bob is getting less than book value is that the firm is worth less than book value. So what we need to do is we either need to write down some overvalued assets or perhaps impair or write off any goodwill that needs writing off. So again, we're going to go ahead and zero out Bob's capital balance. We give him his check for $200,000. And again, the argument is we're giving Bob less than book value because the partnership isn't worth its full book value. We need to go ahead and write down some of the partnership assets. So whether we credit to get rid of or impair goodwill, or whether we reduce some other assets, we need to reduce the net assets of the firm by $50,000.